Hello, everybody. Welcome to Intermediate Accounting, 17th edition video solution walkthrough. Kiesel, Weingart, and Warfield, exercise 1423. The Intermediate Accounting 17th edition textbook authors are Don Kiesel, Jerry Weingart, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons, Inc. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 22 by myself, Bennett Tchaikovsky. All rights are reserved. The opinions contained with this the opinions and the crazy verbal diarrhea that's coming out of my mouth right now. Well, it's not foul, but it's just I'm getting tongue twisted. Within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, verbal diarrhea. I guess you weren't really expecting that out of an accounting video. Okay, so we're now going to come over here and we're going to look over here at exercise 1423. So we want to use the same information and answer the following questions, basically related to American Bank, who is the one who's taking down the note. So what interest rate should American Bank use to calculate on the loss on the debt restructuring? Well, the one they're going to go through and use is going to be the original interest rate that was on the note. And that's essentially, I don't disagree with that. It's because that's what the original interest was, and that was the expectation that the bank was going to be receiving, was that they were going to be receiving 12%. So even though they're reducing it to 10%, given that they were supposed to be getting 12, that's kind of what makes sense to understand what the loss is. So compute the loss an American Bank will suffer from the debt restructuring. Prepare the journal entry to record the loss. So what exactly is going to happen? So American Bank is basically gone through and agreed. And if you look at question or exercise 1422, my video solution for that, what you'll kind of see is that, well, they're reducing their obligation from 3 million to 2.4 million. And they're going to be receiving this on 1/1/24 or 3 years from now. The other thing too is that they're going to be getting interest over the next 3 years, right? So this is going to be the principal. And then they're going to be getting interest payments. Okay, so this is going to be on 12/31/20. Oh, sorry, this is going to be 12/31/21, 12/31/22, and then 12/31/23. The amount they're going to be receiving is going to be 10% because this is what the note rate is dropping down to. So got over here, the principal amount is 2.4 million. Interest payment over here, 240,000 each of these years. Now, their current note payable value or note receivable is at 3 million. So when it comes to these types of questions, though, are future dollars the same as current dollars? And the answer to that is no. What I'm going to have to go through and do is that I'm going to have to go through and compute on a present value basis the values of these different amounts. So for the principal, we'll do the easy one first. So for the principal of 2.4 million, to bring these into today's dollars, I'm going to go present value of $1, 3 periods at 12%. Remember, I'm using 12%, which is the original amount on the note. So I go over here to my present value of $1 table, and I go 3 periods at 12%, and I get 0.71178. Okay, 0.71178. So the value, the present value of the principal is going to be 1,708,272. For the interest payments of 240,000, because these are the same, they're occurring every year. So the one I'm going to do is I'm going to use the present value of an ordinary annuity of $1. This is going to be 3 periods, or the number of times I'm getting interest at 12%. So I come over here to my present value of an ordinary annuity of $1, 3 periods, 12% is 2.44371. So my PV, my present value of the interest payments, is going to be 586,490. So my total present value of the future cash flows is going to be 1,708,000 plus 586. So this is what the value of the cash flows I'm going to be receiving. This over here is my note receivable. So my loss or bad debt expense is going to be 705,238. So when I have a loss like this, I need to go through and I need to recognize this loss immediately. Okay, so that's what I have to be able to go through and do. So the way I'm going to go through and do this, and just give me one moment. Okay, really quickly, I made an error. Over here for the principal, I was using 2.44371. At 12%, this should be 2.40183. So I'm just going to make that change real quick. And there we go. Okay. So when I go through and I record this, what I'm going to do is I'm going to go ahead and debit on 12/31/20 is I'm going to debit bad debt expense, and I'm going to credit the allowance for doubtful accounts. Notice what I'm not doing here is I'm not directly writing down the loan itself. Rather, I'm using an allowance on my loans. So over here, this is going to be a debit of 715,289. And you might be asking, wait a second, this is a loss on a loan. Now they're a bank, they loan out money. So for them, a receivable is like a loan. So to them, tomato, tomato, potato, potato. What you have over here is you're going to have, that's essentially what the bad debt expense is. This is what bad debt expense is going to be for a bank. So this is going to be to record bad debt expense. Okay. Okay, so I've got this first part down right over here. Now I need to look at the second amount of compute the loss or bad debt expense from the debt restructuring. Bad debt expense, same thing. Prepare the journal entry to record the loss. Prepare the interest receipt schedule for American Bank after the debt restructuring. Okay, so what we know is going to be happening over here is that I'm going to be getting, so my cash receipts is going to be 240,000. Let's just copy these over. Okay, so we're just asking for a schedule of interest. Okay, so the cash I'm going to be receiving is going to be 240,000. My carrying value of the note receivable is going to be what? On 12/31/20, the carrying value of my note receivable is going to be 3 million less my allowance for doubtful accounts, or 715,289. This is my carrying value, 3 million minus 715,289. Okay. So my interest expense, right, my interest rate is going to be at 12% for all of these different periods. So my interest expense is going to be 12% times the carrying value of the note, or 274,165. Okay, so actually that's not interest expense. This is going to be interest revenue. Okay, because I'm loaning, I'm the one who has a loan. When I receive interest, it's interest to me. So right over here, I'm going to have interest revenue. And then my the difference is going to be my increase in the carrying amount, or the increase, or basically the difference between the cash And the interest revenue is going to be the increase in the carrying amount and the carrying value of the note receivable. So over here, I'm going to get $34,165. So my ending carrying value for this note receivable is going to be $2,284,711 plus $34,165. So again, this is really kind of to show kind of like the offsetting of the basically to show that reduction in the interest rate. Because we're using the higher rate of interest, we're still going to be going through and recognizing that amount as the interest revenue. Okay, so this is going to be $2,284,711 plus $34,165. Okay, my interest revenue for the next period is going to be $2,238,000 times my interest rate. So my interest revenue is $278,265. Subtract this through, I get $38,265. So my carrying value of my note receivable is always increasing because ultimately I want to get this up to 2.4 million. This is 2,318,877 plus 2,357,142. Over here for the following period, this is going to be right over here, 2,357,000 times 12%. The difference is going to be my increase in the carrying value of my note receivable. So right over here, and I'm getting to the magical number. I'm going to add this to 42,858, and I get to 2.4 million, just rounded it up for fun, plus 42,858. Okay. So that's kind of what's happening in terms of being asked to go through and to prepare an interest receipt schedule for American Bank after the debt restructuring. By the way, if you're going through and when you're practicing in public accounting, you want to make sure that when you're doing these types of entries that you really document it. Will the auditors look at this? Yes, they are going to love to look at this because they're going to want to see, they're going to put that new person out there and make sure that they know, is this good? Then you'll be rushing to my video for the exercise 1423 to make sure that it's all right. Okay, so prepare the interest receipt entry for American Bank on December 31st, 2022. Okay, so over here for the interest rate, basically for the receipt of interest, what I'm going to do over here is I'm going to basically debit, where am I going to debit here? I'm going to debit cash for 240. I'm going to credit interest revenue for 278,265. My difference here is going to go to the allowance for doubtful accounts. Okay. All right. So, and what I want to actually kind of do with this is like, let's actually look at this allowance for doubtful accounts and just kind of follow through with it right over here. So we set up an amount over here on 12/31/20 of $715,289. On 12/31/21, 12/31/22, and then 12/31/23, we went over here and we are essentially debiting this for $34,165, $38,265, and then $42,858. Okay, so as we kind of come down and get down to this, what ends up happening with this allowance for doubtful accounts? Well, with my allowance for doubtful accounts, as it specifically relates to this loan, when I get to the end of the period, it's now going to be at $600,000. Once the loan has been paid back to me, or once the note receivable has been paid back to me, what's going to happen? So on 12/31/23, so on 1/1/24, I'm going to be receiving cash of 2.4 million. Okay. I'm crediting because the note receivable is still on my books for $3 million. Okay. I'm going to be crediting the note receivable. And at this point in time, what I need is, well, to balance this, I need 600 grand. What is that going to be? That's going to be my allowance for doubtful accounts. So it's kind of like we're collecting an amount that had been previously written off. That's one potential way to kind of go through and to describe it. But in this case right over here, we're using the allowance for doubtful accounts. So again, let's just kind of recap this question. Okay, so what interest rate should we use to calculate the loss? We're going to use the 12% because the 10% is essentially like a loan forgiveness. And when you see this difference in the interest revenue, well, why is it higher than the cash? It's because of this 2% spread. Over here, compute the loss that they'll suffer from the debt restructuring. So now that we have the correct present value, I'm taking the principal. I've got a present value that back to today's dollars. So I'm going to use the present value of $1. The interest payment is like an annuity. So I'm going to use the present value of the ordinary annuity. And so the value of this is going to be a total of $2,284,711. And then we've got a loss or bad debt expense for $715,289. Notice here that we're not directly crediting the note receivable. What we're using is this allowance for doubtful accounts. Could I use a discount on a note receivable? I mean, it's the allowance for doubtful accounts is essentially really what it is. It's effectively accomplishing the same thing. So I don't necessarily disagree. I might want to have a separate allowance for this type of loan and then maybe a sub account just so I can track it. But that's what we're going through and doing here. I don't disagree with the solution that the book has. Then over here, what we then have is we then say, okay, we've got now what's going to happen is as this customer starts paying me the interest. So I've got cash coming in, but the interest rate I'm using is going to be 12%. So I'm taking the carrying value of the note, which is essentially the amount of the increase in the carrying value through the allowance for doubtful accounts. This is ultimately what's going to be increasing this amount up to 2.4 million, which is the amount I'm going to receive on payment day. However, right, if I look at the allowance for doubtful accounts, I started with this $715,289. And I amortize this for the interest revenue by 34, 38, and 42. And now my final write-off is happening over here because once this loan is paid off, the loss is essentially, it's like a recovery of an amount previously, actually, it's not a recovery of amount previously written off, but it's a final write-off. So I'm going to be debiting the allowance for doubtful accounts because this should no longer be in here. And I'm essentially the crediting notes receivable over here. So hopefully that wasn't too confusing, but again, my suggestion to you for this type of problem is to make sure you're going through, you're creating the tables, and just that's all you can do is practice, practice, practice. So over here, I want to thank Wiley again for allowing me to use their videos. Maybe after this video, they'll say no more, but if you want me to make other solutions for other Wiley problems that are in the chapters, feel free to ask me in the comments. Have a great day, and I look forward to seeing you in the future. Have a good one.